Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through a bunch of different articles that I've seen, a bunch of different information, some from Twitter, some from oilprice.com, and I'll give you my opinion on it. So let's dive in. Let's see what we got. We've got Japan to release 6 million barrels of crude oil from private reserves. Looks like Japan's trying to tamper the price down, and to me, it just looks like everyone's getting desperate to try to hold the price of oil down. But Japan is set to release a total of 15 million barrels as part of the IEA's stockpile release. 6 million barrels will come from its private reserves, while 9 million barrels will come from its state reserves. According to Reuters, Japan had 470 million barrels of crude in reserves at the end of January. Going next, it says demand destruction may kick in after lithium price explosion. Lithium prices are beginning to slow their climb after a 500% rally. High lithium carbonate prices have begun to dampen demand. The EV industry has failed to secure a sufficient long-term supply of battery metals and is now dealing with the consequences. So why were these people? Let's just kind of get into this article a little bit. I do think that lithium, since that's the first one to go in a large deficit, where supply cannot meet demand, I think this will be a prelude to all of the other metals and energies. This is a prelude to what they might do as well. So they may run all the way up and then kind of just sit up there once the price really moves higher. So that's kind of my guess, at least. It says it happened because the car makers were asleep at the wheel. They were not paying attention to the raw material supply base. They were too far removed. If you are an average car or EV maker, you're a cell maker. Today, you're just about hitting the panic button. Historically, the battery price cost curve had been declining at a pace of 3 to 7% annually for so many years in a row, it almost seemed inevitable. The bank's analyst wrote in late March, but molecules don't play by the same rule as Moore's law. The world has changed, and along with it, it is a new paradigm of input costs. And that's exactly what I'm talking about with all of these EVs, with all of anything in this world. When we hit deficits of metals, when we hit deficits of these materials, the input costs are all going to go rocketing, which will be inflation in terms of CPI numbers. Not true inflation. Inflation is the increase in the money supply, but this will be, they call it product inflation or CPI inflation, which will show up in all of the data that most people watch and track. It says it's going to take some time for the mines to catch up, Pilbara Minerals told Sydney. Mines take several years to put into operation. Even if the lithium rally slows down, it is not reversing for years yet. And that's exactly what I think with the majority of metals that are going to be in deficit here coming up, with energy, with house prices even. We don't have the inventory to reverse it. So I think they will remain elevated for a very long time and probably hit some sort of equilibrium point, wherever that point is. We have not hit that yet. So looking at, we've got the U.S. natural gas inventories fall to a 3-year low. Higher exports and elevated demand have pushed U.S. natural gas and storage to its lowest level in 3 years. Gas's underground storage in the lower 48 states totaled 1.4 billion cubic feet as the last day of March. The U.S. is expecting record volumes of LNG as the United States looks to help European allies with non-Russian gas supply. This is going to drag or pull, it's going to pull natural gas prices up in the United States. It's also going to, there's also going to be a shortage of LNG shippers, I think, because we're going to be shipping this stuff everywhere. As much as we can, however much the terminals can supply. Now, going into some other stuff here, we've got new posts, the inverted yield curve omen. And the first yield curve inversion and then the lead versus recession start. So how long did it take for the recession to start? So the yield curve first inverted in 78, August, and 18 months later, the recession started. So it was 18, 11, 20, 35, 25, 7 for this guy here, and we don't know how long it's going to be for this current one if the yield curve first inverted April of 22. It could be somewhere anywhere here. The problem is when someone says, oh, we're going to get a recession, and then they start throwing out numbers, you don't know exactly how long it will take. And between some of these, like December 05 is when it first inverted. If you look at like December 05 and then the end of the bull market for uranium, some of those companies went up 20 or 30 fold. So if someone says, oh, we need to get out, well, you could be missing a 20 or 30 fold move in uranium. And this is exactly the same time it happens with the yield curve inversion and money rotating into uranium and other assets. So I think we have a huge boom coming probably in about, from now till maybe say 12 to 24 months out. That's when it'll probably end in a short-term liquidity type movement. We've got inflation rates. We've got all these inflation rates. The US 8.5% higher than everyone else. Usually you'd see the dollar get weaker if we have higher inflation rates than all these other ones. It's kind of weird. And central bank rates, pretty low rates. It's crazy. US export prices increased 18.8% over the last year, the highest on record, while import prices increased 12.5%, highest since 2011. Looking at this, the US bond market is down 10.3% from its peak in August 2020. I started the channel in August 2020 so that where commodity market was coming and that bonds would go down. There it is. This is the longest 617 days and largest correction in bonds that we've seen in recent history. Here's the correction in days, and this is the previous history here. And these are the percent declines. Keep in mind that we might be going into a new paradigm, so we should see a very large decline in bonds versus other times in recent periods because we were in a declining interest rate environment, and I think we're in an increasing interest rate environment for some period of time. Coming over here, commodity chaos is threatening the global economy. Global supply of key food and energy commodities is starting to impact the global economy. Rising core inflation and hawkish central bank policy could further impact economic growth. The global price index of all commodities has more than doubled since its pandemic low. If the year ended today, it would be the worst in history for the U.S. bond market with a loss of 8.5%. Entering the year, the 2.9% decline for bonds in 94 was the largest ever. Yeah, we're getting some pretty bad performance out of bonds. Home prices changes since 2000. The United States is a laggard outside of Japan. Japan's just, they're going down. But US is a laggard. I think this will actually catch up to Australia, Canada, and UK, and I think will actually go up. Why? Not because of interest rates, obviously, but because we have a housing shortage. That's why. And then speaking of mortgage rates, average 30-year mortgage rate in the United States, 1970s 8.9, 80s 12.7, 90s 8.1. So we are actually still at a pretty decent level. The only thing that I will say is that we've gone up. It's a dramatic increase since the lows of 2020 and 2021. So the rates have increased dramatically from the bottom, and they will have an impact on affordability. I do not deny that. I just know that we've got a shortage over in housing, and we'll see how that all plays out. We'll continue to monitor it. On the right-hand side here, the 30-year mortgage rate in the U.S. rises to 5%, its highest level since 2011. The 1.15% spike in mortgage rates over the last 5 weeks is the largest 5-week increase we've seen since 1987. So the rate of change is quite dramatic in the 30-year fixed-rate mortgage. And we got to see how that impacts prices and demand. The Fed's balance sheet hit another record high this week at almost $9 trillion. U.S. inflation moved up to 8.5%, its highest level since 1981. This is the Fed's balance sheet, and it continues to go up. And same with the U.S. CPI year-over-year consumer price index. The U.S. Housing Affordability Index has moved down to its lowest level since 2008. This is based on February data when mortgage rates were over 1% lower than they were today. The result: current affordability is much lower, plummeting over the last 2 months. This is the affordability since 2008. We have a long way to go to get to 1980s affordability to the downside, if we are going to match that, which I think we probably will. So that's what I've got for today, guys. I just wanted to go over some information. Since the markets are closed, I'm really grabbing information from Twitter and whatnot. Subscribe to the channel if you haven't. Give me a thumbs up for the content. And check out my website, the Platinum membership below. I'm going over all sorts of different investments. I'll probably do a model portfolio here soon and say this is where I would be adding money if I had to start a portfolio from scratch. This is the companies I would select. This is how I would weight it, perhaps. And that's kind of what I would do. Doesn't mean that's what is good for you, but I could give a model portfolio and based off of today's, I should say, opportunities, and we can track that if we want to. All right, guys, we'll catch you next time. This is Finding Value.